Hi, my name is Steve Freed. I'm Vice President of Research for ADM Investor Services. The purpose of this video is to give you a recap of the recent USDA crop report and world supply and demand numbers. On November 8th, the USDA came out with their first report since September because of the shutdown in the government. These are my thoughts and not those of ADM Investor Services or ADM. When the government came out with the numbers in corn, they were in line with most expectations, and the market had a short covering reaction. Funds were record short going into the report. In the beans, the market actually rallied. USDA raised the U.S. crop, and they raised demand, but they also lowered world supply, and all those things helped the market rally. As far as the price sheet, the USDA is looking for 2013 and 14 wheat prices to be about down 10% from a year ago. Corn prices down about 35%. Soybean prices down 15%. And meal prices down about 18% from a year ago. We're also looking for cattle prices to be a little bit higher, while hog prices are lower. When we look at the composition of the trading market, we basically trade three things. Number one is weather. Number two is money flow. And number three is the S&Ds. When we look at the USDA's corn supply and demand, the first thing they did was they lowered acres because of the wet spring. Then they raised the yield because of the good summer. They also raised feed usage a little bit and exports a little bit and kept the carryout unchanged. There are some that would feel that by the end of the numbers crunching in January, the crop may even get bigger and the carryout may get bigger. And when we look at the December futures chart, which has been going down steadily since last fall, we would think that prices should continue to work lower if the crop and carryout gets bigger. If we look ahead for 2014 and 15, we're thinking that maybe the U.S. farmer will plant a little few acres. But then, if we have a trend yield and normal demand, the carryout will increase even more. And that should be bearish 2014 prices. When we look at the U.S. soybean supply and demand, they did exactly what the market was expecting. They raised the crop yield, they lowered acres, they raised demand, and the carryout was raised marginally. And the market would think demand still could be even bigger because mostly the lack of sales of beans in Argentina and lack of exports out of Argentina. That could support the nearby futures market. When we look at the January futures contract, it's in a trading range between $12.50 and $13.50. And we probably will stay in that range. It's going to be tough to get below that price because a farmer here in the United States needs to sell beans into the pipeline, and it may be tough to get over that price with favorable South American weather, and the farmer here in the United States is a good seller there. When we look down the road into next year's supply and demand, we could see U.S. farmers increase acres. We could see farmers, after we assume a good crop, higher carryout and lower prices. On the wheat supply and demand, they really didn't do very much of a change. They did raise world index stocks marginally, and I think if we look at where the world crop is right now, where the ending stocks are forecasted, and where the carryout next year might go to, we would think that prices for wheat will continue to trend lower. When we look at the next slide, the carryout for U.S. is expected to go higher, and that's in part due to a little bit more acres, but more in generally, the current winter wheat crop that's growing in the United States is rated the best since 2008. When we look at the weather, our focus right now is in South America, and the conditions down there are ideal. Argentina started dry, but now they're getting normal rains, and for the most part, Brazil's seen normal rainfall. And for the next 30 days, there's not expected to be much change. When we take a look at the U.S. situation, we're expecting a cold, wet winter in the eastern half of the country. But when we take our first look for the spring of 2014, it looks normal, with rains across the Midwest and normal to temperature. So that's probably a good start for 2014 crops. Now when we look at money flow, the traditional funds are the drivers of the market every day. They're momentum traders, they look at moving averages, and you can see that in 2012 during the drought, they had a record long position for corn, soybeans, and wheat. They pretty much liquidated that position. And right now, they are short corn, they're short soybean oil, and short wheat, and long beans and meal. And the question is, what are they going to do from here on out? You might see them lighten the load a little bit in corn. Certainly there's some positive information about soybean oil, especially palm oil. And in the wheat, they might continue to have a short position. In beans and meal, they could slowly get out of those long positions as long as there's favorable South American crops. As far as the index players, in 2005, they came into our markets as long only. It was a hedge against inflation. It was due to China buying commodities, and it was due to the fact that they were hedging against inflation. And they also have had less than normal weather conditions across most of the U.S. and world. We expect them to keep their positions until more is known about global economy and what's going to happen to the growth of the economy worldwide. Again, these are my thoughts and not those of ADM or ADM Investor Services. Again, recapping what we think is going to happen is 2014, assuming normal weather, prices of corn, soybeans, and wheat should trend lower.